Okay, so good morning, everyone, and welcome to the Macro Snapshot. We are Wednesday, May the 14th, 2025. It's about 7:30 in the morning as I'm recording this. Okay, so let's have a quick look. Yesterday, we had a bit of a continuation of the risk on. Overnight, that is somewhat diminished. And basically, that was a continuation, I think, yesterday being Tuesday, of just this news over the weekend that, Besant had met with his Chinese counterpart in Geneva. This sort of idea that there's going to be a trade deal at some point between the US and China. So some positive news there. The second thing yesterday is that Trump was in, or still actually is in the Middle East, in Saudi Arabia, and he announced, depending on which number you believe, $500-600 billion worth of deals. But especially what got the kind of the market's attention. I mean, there were quite a lot of sort of agreements signed or letters of intent, but especially quite a lot of sort of orders for advanced chips, things like NVIDIA, with the most advanced chips being sold into some of the data centers in the Middle East and Saudi Arabia. So a very positive day for NVIDIA, for the Nasdaq, and just in general for risk, and this idea that Trump has been quite pragmatic. They're going to try and sign some deals. He's very much trying to push business interests, and will generally not want to see the stock market or the US economy sort of having problems. So there was a bit of sort of positivity and risk on. So we saw, let's have a look. So we saw the VIX. The VIX continues to be very, very, very low. We also saw the S&P 500 sort of break above, sort of recent sort of swing highs here and doing pretty well. The other thing as well this morning, just talking about Trump, is that his economic advisor, Hassett, has said that, there's like 20 or 25 deals which are sort of very close to being signed, and that once Trump returns from the Middle East, he will announce the next sort of major deal. So, definitely the White House is attempting to pump the markets and to sort of keep the positivity going. And who knows, maybe that's justified. My personal view, there's a couple of things here. We'll look at the markets in a second. But for example, if you look at real yields, yesterday we had the nominal yields going up, but look at the real yield here on the 30-year. So this is not the nominal yield. This is on the 30-year yield, but the real yield. So the yield you get above, approximate inflation. And you can see that that's been sort of rising steadily. This year, we're now at sort of 2.65%. So the question here is, if nominal yields get up to, let's say, 5%, possibly if they go a little bit higher, you're going to have a real yield here of 2.75% on the 30-year. And first of all, just one thing I'd say, that starts presumably to become attractive for, things like tips or maybe even the 30-year yield at that point, or, inflation protected bonds. But what's interesting is that if you have a real yield of 2.65%, that starts to put quite a lot of pressure on equity valuations and just the real economy in general, because that is essentially a longer term interest rate, which is relatively sort of restrictive. If you're paying, if yields are costing, the interest rate is 2.5 to 2.75% above the inflation rate, that is definitely going to make sort of investors think. And could that lead to sort of some sort of heaviness in the stock market? Anyway, so just talking about all the markets. And that's what's interesting, because we look here at the ES. Obviously, we've had a big V-shaped kind of bounce back. We're now above the Trump tariff announcement, which was on April the 2nd. So down here, we're above all kind of Fibonacci levels and whatnot. So for sure, from a technical perspective here, I'm just going to put on some EMAs here. So from a technical perspective, also you can see the EMAs sort of starting to turn up a little bit. They're a little bit flat. There's absolutely nothing to say the market can't retest these sort of highs which we had at the beginning of February or the middle of February here of about 6,100 or so. So let's see how we go. At this point, it's maybe a bit late to chase, and definitely the White House is starting to pump. But at this point, this has cleared the technical hurdles. This recent high, it's above the moving averages, it's above all the Fibonacci levels, and you have to say that the markets do like to test. So it would not be surprising if it does test up a little bit higher. At that point, who knows? That could be a week or two away, even sooner. Maybe there's going to be a few more complications with the negotiations with China. There's still no deal with the European Union. Let's see if what Trump announces upon his return from the Mideast becomes a disappointment. Would that be enough? So just taking a little bit of a pause this morning. And if you see just to quickly, you see Nasdaq also having a similar kind of situation here. Again, pretty positive news yesterday in terms of NVIDIA, and it does seem, just stepping back, that definitely Trump Trump does not want to have as restrictive an export policy on those on the most sophisticated sort of AI chips. So for companies like Nvidia, that is and AMD, that's pretty good news. Just looking again, let's have a look at the Mag 7. Again, pushing higher. That could be coming to some kind of resistance here at about 52.50. You see here, this is sort of a bit of a level. But again, this is, cleared fibs, and it's the moving averages moving higher. If we look at the equal weight also doing, relatively well. So overall, you have to say that this is, quite a strong positivity. But again, I'm going to draw everyone's attention, including my own. If you look at also what's happening here, the yields are pushing up on the 10-year, as I mentioned a bit earlier, up to 4.446, getting up towards the 450 mark. And then if you look at the 30-year yield, that's pushing up to 4.9. Let's see, who knows if we might even get up to 5. And again, what I'm trying to say is that for example, we had the CPI yesterday, and that seems to have come in a little softer than expected. So at this point, we have still a relatively, restrictive sort of longer term yields. So the question is, as I said, at what point will the stock market pay attention and say, hey, we don't like these real yields at a 2.75%. Now, in terms of the CPI yesterday, it did come in about a tenth softer than expected. So there was not a huge market reaction. Well, except you could say that the stock market, that was part of the positivity. But just to keep things in perspective in terms of the Fed, and just while I'll just go through some of these comments here, just keep in mind what's going on with the Fed funds rate. And we can see here that the Fed funds rate is still quite hawkish. There's been a tiny bit of repricing. So we can see here in the US that if we go to the December of this year, just over 2 cuts. So yesterday got just down to 2. So it has come up to a little bit more. So just a tiny bit of dovish repricing here. Which you can see here, if we look here, this is on a 10-minute chart going back about 15 days or so. But you can see that on December, going all the way back to the 1st of May, which is, what's that, 2 weeks ago, 4.2 cuts. So there's a whole 50 basis points of more hawkishness, which has been put into the market here. So a very substantial sort of repricing of this, in this particular case, expectations for December. And as you can see, we're just around about 2. So I think the market might just want to settle there for a moment. But if we get any sort of softening of the data, this could very quickly go to 2.5 or 3. So down here, and obviously, a big softening or a collapse in the labor market, this would get to 3.5 or even 4 in a hurry. The question is, can this get, what would make this re-hawkishly price even more? So let's say 1.5 or 1 cut, so pushing up. I suppose if, the Fed comes out and keeps on saying that they're not interested in cutting, if trade deals continue to be announced, and more specifically, if those tariffs, let's say at the moment, people's talking about a 10 or 15% universal tariff, or on average, if those tariffs can keep on going down to 7%, 6%, 5%, that's going to be a positive. Also, we have to look at what's happening in Washington with the negotiations for the budget. It is looking increasingly potentially as though Trump does want to get some tax cuts done, and that the deficit will not be cut that much. So, it looks as though Elon Musk has gone out of the news, and Doge, and cutting the deficit. So it looks as though the deficit, I was looking at some numbers yesterday, the deficit is still projected to be almost like it was with Biden. So very high deficit, a lot of government spending, not so many cuts, and possibly even tax cuts. So if you put this all together, this could be a little bit more sort of a stimulus, in terms of policy and whatnot, and also tax cuts, and that could just keep on supercharging the economy. So at that point, you've got to say the Fed may not see any economic weakness. It may continue to see some sticky inflation, and basically we'll see no reason to cut. Now, this is saying by December of this year, 2025, we're going to get 2 cuts. So that's still 6-7 months away. Let's see what happens. But I think for the moment, the market is probably quite happy here for the next day or two. Now, just in terms of Fed reaction function, we had Goolsbee speaking yesterday from the Fed. He is a voter in 2025. And I've just got here some of the quotes he said. So he's having a little bit of tea. And just interesting, his perspective, at least, he said, this is a quote, some part of the CPI report was lagged data. So he's basically saying, this is kind of lagged data, so we're not that interested. Secondly, the Fed is still holding its breath. Also, it'll take time for the current inflation trends to show up in the data. So it'll take time for the current inflation trends to be seen in the data. So essentially what he was saying in his comments, I looked at the speech, was that he still believes that the tariffs, there will be tariffs, and the tariffs will have some kind of inflationary effect, and we're still lagging the data, and we haven't seen it yet. So basically, the tariff-induced inflation effects will have yet to be seen. So therefore, he doesn't want to cut. And he said it's a good time for the Fed to wait. So all that to say that someone like Goolsbee on the FOMC, the Federal Open Market Committee, basically saying, hey, we haven't seen the inflation data yet. We need to wait. Things are in a good space. No need to cut. And actually, I'm still a bit nervous. So at least from Goolsbee's perspective, absolutely no sort of necessity to be cutting quickly. So that brings you to the point now. And you can see here, for example, just what the market's done, just getting back to the earlier stuff. You see here the Fed funds rate, so each dot here represents 1 month. You can see this is from now, which is the live feed, live data here on the Bloomberg terminal. And then on 1 month ago, is the blue. So you can see here that all across the curve, but especially, as I keep on liking to say, towards, the October, November, December of 25 and going into, the early part of 2026, you can see here really where a lot of the repricing has been, and repricing in a hawkish way. So the Fed at this point, we still looks as though we have a terminal rate down about, 315 or something like that. Yeah, 310. And if you keep in mind that currently the Fed funds rate is a 4.3-ish, 4.33, that's about 110, 120 basis points for the terminal rate here. So not that much of a cutting cycle being priced in. We'll see what's happening. Now, just in terms of inflation, as I say, the inflation print yesterday was a little softer than expected. So it's pretty normal to see here the 1-year inflation swap. So this is what the market is pricing in terms of inflation premium for 1 year out. You can see that it has sort of fallen a little bit. So that's shorter term inflation expectations are falling and inflation swaps. And you'll also see here, let's say on the 2-year, the blue, and then the 3-year, this kind of orange, and as we go out the tenors. So we're still seeing that it's starting to drop a little bit and relatively stable. So the question here, inflation is not at all crazy, and it's definitely sort of stabilized. But we have this situation that it actually is probably like 20 or 30 or 40 basis points higher than the Fed is comfortable with. And there's still the bogeyman, there's still this fear that we ain't seen nothing yet, and that the tariffs will ultimately cause maybe a continuing inflation or maybe just a one-off price shock. And that's why the Fed is reluctant at this point to supercharge the economy, but with a cut, even though Trump, of course, yesterday was still saying that Powell was, I don't know, he was calling him stupid and too late and all that kind of stuff. We'll see. So that's where we're at. Okay, guys, so there's not a huge amount of data today. In fact, there's not much data. Tomorrow is quite data heavy. We have retail sales. We have initial jobless claims and Empire and whatnot. But basically at the moment, the market's having a little bit of a pause overnight. You can see here that the US dollar, interestingly enough, couldn't maintain its strength. And so basically, even with this sort of, relative positivity, the market is still concerned structurally. You see here the dollar index over the last, let's say, 36 hours has actually come off a little bit. We're seeing a little bit of strength in the Japanese yen. If we look here at the USD, we can see the USD's come off again in the last 36 hours. This resistance I was talking about yesterday, and also in the euro, we can see the euro, at that 50-day moving average, and it's kind of almost like a sort of a fib retracement level here. So a bit of resistance here, just starting to push higher as well, and some of the commodity currencies like the Aussie pushing higher as well. So in general, what we're seeing is that the yields are going up, but the US dollar is not benefiting. So that's an interesting dynamic there. That ordinarily, when the nominal yields go up in the US Treasury space, the US dollar would follow higher. But we're not really seeing that. We're starting to see that dynamic, which we noticed 4, 5, 6 weeks ago, that there's a bit of a sort of uncertainty here about the US dollar. So that's something to keep on looking at. In terms of other stuff, we had oil. Had a nice little pop. Where are we? Where's oil? So this is a crude oil here. We had oil, but again, coming up to the 50-day moving average and the 50% Fibonacci retracement, just a little bit of a pause. It's going to be curious to see if that has a lot more energy. Possibly also geopolitics. Trump was talking to the Syrian, I think it's president or prime minister, I think president, and basically saying he's going to take sanctions off off Syria. Definitely, there's quite an attempt by Trump to kind of smooth things over in the Middle East. So who knows? Maybe less sort of tension in the Middle East is causing oil just to sort of give back a bit of its gains here. And interesting that even with the softer US dollar, oil this morning not really able to do too much, although that correlation has broken down in the last few years. Okay, guys, so I'm going to leave it there. Not a huge amount happening today. So really, the story today is just whether sort of continuing sort of low volatility will enable the stocks to keep on pushing up, maybe to that sort of high of the February high. We shall see. Apart from that, let's see if there's any headlines, but maybe just a bit of a day of sort of consolidation. Okay, I'll leave it there. Thank you. Have a great day. We'll keep the conversation going. Thank you.